Okay, let's talk about these zombie mortgages. What are they, and what can you do to make sure that you are safe from them? To get started, I want to share this article from NPR. Zombie second mortgages are coming to life, threatening thousands of Americans' homes. I saw this article recently. I had a totally different plan for today's episode. And then seeing this article got me so fired up about what was going on, I had to share it with you. It's a long article. Listening to it, it would be a 30-minute listen. If this is a topic that interests you or you want to explore it more, I recommend you read the whole article. But what I'm going to do is scroll down here to a section that says millions of Americans got second mortgages during the housing bubble. Most of what I skipped over in the article to get to this point involves stories of people who are victims of zombie mortgages. One of those individuals remembers the first time she drove up to her little future home in Quincy. It was 2005. She had just gotten a divorce and was renting an apartment nearby with her two sons. I thought the size was kind of charming. It had a yard, she says. I thought it would be perfect. And for $365,000, it seemed affordable on her income as a nurse. There was only one problem. She had a good job and modest savings, but she hadn't saved up a big down payment for the house. Back then, though the housing bubble was heating up, the mortgage companies were finding all kinds of ways to loan people money, and one was a system that got rid of down payments altogether. Instead of just one mortgage, lenders would give home buyers two. The first loan covered 80% of the value of the house, and the second mortgage covered the remaining 20%. They were called 80/20 loans. And that second mortgage, the 20% mortgage, meant a home buyer didn't need to come up with a down payment. My understanding of the laws around this is you have to come in with some sort of down payment to qualify for particular mortgages. I don't know if it was different back then or if this was legally questionable. I know it's definitely not legal today. It was the easiest thing I've ever applied for, she said. I just filed out the paperwork and submitted it, and I was approved. Her first mortgage was for $292,000, and the second one was for $73,000. The yellow cottage sized 2-bedroom house was hers. She and her kids moved in. I gave them the master bedroom because they shared that room, and then I took the smaller room, she said. But it was good. And then she slept each night in the tiny bedroom. A couple of years went by, and the housing bubble collapsed, sending the world into the worst financial crisis in generations. Banks were going under, people were losing their homes. A big reason for this was that the terms of many of those housing bubble era mortgages had a time bomb inside them. After 2 years, the interest rates on the loans were set to explode and go up much higher. Mortgages that do that are adjustable rate, ARMs for short. I do not recommend ARMs for this very reason. Moving along, in 2007, her first mortgage adjusted, and the monthly payments were suddenly $700 a month higher, which she couldn't afford. This was happening to millions of Americans. It was happening to so many that the federal government launched a nationwide intervention, a loan modification program to save at least some people from foreclosure. In 2008, she was able to get her first mortgage modified to lower the interest rate and make it affordable again. This was the crucial moment that would eventually lead to those standing on her front lawn. Earlier in the article, this woman's story started with a foreclosure auction. Her home is being auctioned off without her really knowing why. She says her mortgage company told her not to worry about the second mortgage anymore, that it was written off and forgiven. It's the understanding of written off versus forgiven, or written off and forgiven, that really is the source for confusion on this zombie mortgage stuff. See, if a bank writes a debt off, they just consider it a loss, but they don't necessarily forgive it. It still exists on their books. And even if they say it's forgiven, if you don't have that in writing, it may still live on the books. I was actually in my kitchen. I was cooking dinner. and I was talking to a representative, and he told me I just would never have to make a payment again on the second mortgage. She said, and I just didn't question any of it because I was so grateful that the loan was modified. And see, there, at least in the story, there's no record of her getting something in writing that says that the second mortgage was forgiven, just that she wouldn't have to pay anything on it moving forward. There didn't seem to be any reason to question it. The same company had given her both mortgages. She says that after a while she stopped getting statements on the second mortgage. She thought it was dead. I want to take a break from the article now and do a little bit of history on the housing bubble. You see, Louis Ranieri was a banker who, back in 1977, introduced this concept of mortgage backed securities. The very first mortgage backed security, as his brainchild, I believe, was actually produced by Bank of America, a very large bank that I have strong feelings about, for reasons you may or may not know about now. The mortgage backed security did very well. It was very popular because, think about it, as consumers, what kind of debt are we most motivated to pay off? What kind of debt will lose us the most if we don't pay on it? It's going to be our mortgage. It's a secured debt with our largest purchase that we're probably ever going to make in our lives at risk. So investors saw mortgage-backed securities as very safe. And as they were becoming more and more popular and people were taking derivatives out on mortgage-backed securities, blowing up the housing bubble, banks were being naturally incentivized to give out more and more mortgages. This is why, to my understanding, these 80/20 mortgages were a thing. This is why subprime lending with adjustable rate mortgages became rampant leading up to 2008. And this is why millions of Americans took out second mortgages, HELOCs, 80/20 style stuff throughout the early 2000s up to the crash. Banks were in complete disarray during the Great Recession, and thousands of foreclosures were happening. If you lived through the crisis and remember it at all, it's something you're probably never going to forget. It was a crazy, stressful, tragic time. And because of that, I'm sure you can understand that banks weren't necessarily keeping the best of records and mistakes were made. Some of the mistakes might have been communication error with borrowers on what actually happened to their second mortgages, be it the 20% mortgage or otherwise. Maybe it was they said it was forgiven. They thought it was forgiven, but they kept it on the books. Either way, because housing prices crashed so horribly, the second mortgages were worth almost nothing during the Great Recession. If there was a foreclosure, the first mortgage would get priority over the second mortgage. It's just the way it works. And prices had dropped so much that the second mortgage would probably get nothing if there was a foreclosure. And you can understand why banks would write the second mortgage off. They see home values crashing so much. These, in their opinion, are worth nothing. They're never going to be able to get anything for them. They're almost unsecured because of the situation. And herein lies the opportunity for the debt buyer. Because these second mortgages were basically just worthless, but still tied to the home on paper, investors, debt buyers purchased up a bunch of these. And they would buy them, hold them, sell them, shuffle them around. Second mortgages can sometimes have more than 5 owners since the 2008 housing crash. And your second mortgage doesn't have to be tied to it to become a zombie mortgage. It just needs to be something that you think is dead and then comes back to life. In hindsight, the Great Recession was tailor-made to produce many zombie mortgages. So here's what's happening now. Homes have appreciated and first mortgages are no longer predominant over second mortgages. There are lots of homes that have been paid off where the second mortgage has a fair claim to a home as something to secure against debt. Now, because it's been dormant, many people have forgotten about them because they're dead. right? They were dead. But when they wake up, what happens is you get phone calls, you get statements saying, hey, you owe money on this mortgage from so many years ago, because spam calls are so frequent and scams about debt forgiveness are all over. People just ignore them, even though they're legitimate owners of paperwork tied to that second mortgage, tied to that second debt, which is indeed secured by your home. And this can happen on a home that's changed hands multiple times. It's not supposed to, but it's possible, which leads me to another little rabbit trail to talk about title insurance. What I have here is Investopedia's article, What is Title Insurance, Why You Need It, and How to Buy It. Basically, title insurance is summarized here at the top as a form of indemnity insurance that protects lenders and home buyers from financial loss sustained from defects in a title to a property. It's a lot of jargon just to say that when you buy and sell a home, it's got to have a clean title. The liens that are on the property should be taken care of in advance of closing. However, people make mistakes. Title companies make mistakes. Lenders make mistakes. And sometimes a title can have an error or an unfound lien, even though the title company is supposed to do a good job searching through all the records. Flawed records can exist. Basic owner title insurance policies typically cover the following: ownership by another party, someone who has a second mortgage or whatever, saying that they own your home. Incorrect signatures on documents, in addition to forgery and fraud. Flawed records. Restrictive covenants, terms that reduce value or enjoyment, such as unrecorded easements. And then encumbrances or judgments against the property, such as outstanding lawsuits and liens. A lien can be filed against the property by an investor who has a second mortgage on the home, and that lien is what can lead to a judgment and foreclosure. In essence, if you are a home buyer, zombie mortgages on their own, in my opinion, are enough of an incentive to buy title insurance. My understanding, and I'm not an attorney, I'm not a real estate agent, I'm not a licensed financial advisor, but my understanding of this topic is that title insurance can be very valuable in protecting you from a dirty title or unfound records on second mortgages that have died and disappeared and try to come back to take your home from you. In most cases, if you've purchased a home and you have a mortgage on it in the last few years, you were probably required by your mortgage lender to have title insurance. And it makes me smile that the lenders, the banks, who are pulling out the zombie mortgages right now or have sold the zombie mortgages to investors, are requiring title insurance in order to protect you and them when they get involved in a new lending agreement. They know better than anyone the risk that's involved there. Okay, but let's say that you didn't buy a home with a zombie mortgage and you don't have title insurance to protect you, that you had taken out a second mortgage. You took out one of these 80/20 mortgages. You have a HELOC that at some point you thought disappeared. You thought it was paid off. And all of a sudden, it comes back to life to try to bite you. Hungry not for your brains, but for your equity. What do you do to fight it? Well, if the zombie mortgage has woken up past the statute of limitations, which is dependent on state law, again, not an attorney, not a lawyer, but just expressing my understanding from this topic. If it is past the statute of limitations, you might be able to partner up with a real estate attorney and fight this thing on that basis. If the zombie mortgage has a legitimate claim on your home that cannot be fought in court for any reason, well, you might need to communicate well with the zombie. Invite them over for tea, get to know them. I kid. What you need to do is communicate with the lender who owns your second mortgage, be it the original lender or someone who bought the debt from them. You need to talk to them, explain the situation, try to work with them. Communication is key. This is going to be true in any debt collection situation. And if they're not willing to work with you, you might need to resort to bankruptcy in order to block a foreclosure. I'm, again, not an attorney. You should talk to a real estate and bankruptcy attorney about that option if it's what would be best for you. Another thing you could do is refinance. Just today, I was on a business meeting. I was on a call and I talked about zombie mortgages as a safety share. We start a lot of these meetings for work with someone being assigned to safety share. I brought it up, and one of the 12 people on the phone call or so said, "Yeah, Jay's right. This is a serious thing. Just recently, I had a zombie mortgage come up on me, and I had to refinance in order to take care of it." This isn't a small issue. It's not a rare issue. Zombie mortgages are everywhere. And if you're fighting one and you don't have the equity to feed the zombie to get it away through refinancing or some other means, there is something else that you could very well appreciate knowing and discussing with a real estate attorney. And that's going to be knowing about the periodic statement rule. This is a law on the federal books, 12 CFR 1026.41. This is a law that requires mortgage lenders to basically provide regular statements as to what's going on with the mortgage. There are a lot of rules. If you can see the video, I'm not going to read them all, but Brave Browser's AI has been nice enough to go through and summarize 12 points that monthly statements or regular statements are to include. I don't know if it says that it has to be monthly in this law. I've not read the law in its entirety. I just know that it exists, and I know that it is a successful way that many have been able to fight off zombie mortgages through. And it's not just me saying that. Back to the NPR article, a crossbow to fight zombies in many cases is that debt collectors who are adding years and years worth of interest and late fees on top of the amount that the homeowner had originally borrowed sometimes can double the size of the debt or worse. Federal regulations, however, say that a company can do that, but it has to send monthly statements, like the ones that you get for credit cards or student loans, or a regular undead mortgage. Regulation Z, which is a part of the Truth in Lending Act, Kelly said, it requires that monthly statements be sent if there is interest assessed on the mortgage. This might be different than the law that I ended up looking up, but it, in essence, is saying the same sort of thing. A lender needs to send you regular statements. In many cases, she says, this just never happens. The homeowners never receive any kind of communication about these loans for years, and debt collectors piled on massive amounts of interest and fees retroactively. In some cases, the greed of these second mortgage holders has given people leverage in their cases, Kelly said, because it's just not good enough to collect the value of the note, and they want to go and get every last dollar and take every dime of equity. By violating Regulation Z, Kelly says they then open themselves up to serious legal consequences and provide consumers the leverage they need to stay in their homes. This is just one strategy, but Kelly has been using this approach to help homeowners in dozens of cases. She just resolved a class action case where she was able to get the names of nearly 300 homeowners from one company to help them all. And the Kelly being mentioned there is Christy Kelly, who is an attorney for a law firm in Virginia. She was quoted in the NPR article discussing what she's done to help people who are victims to zombie mortgages. As we wrap up, I am hopeful that today's episode has not only helped boost your understanding of what zombie mortgages are, but emphasize the importance of getting written record when any debt, be it a mortgage or credit card debt or a personal loan, whenever you pay off a debt, have written record that it was forgiven, it was paid off, that it is gone, that it's dead. Because that can be a tool that you can use to fight that if it decides to try to become a zombie, but doesn't have enough to get out of the ground. And I also hope that today's episode's been inspiring on the different ways that people have been able to fight off zombie mortgages, so that if you or someone you know becomes a target of a zombie mortgage, that you can discuss it and help point them in the right direction or seek out help from a real estate attorney who can discuss this with you now on a basis where you feel like you can understand what's going on without an overwhelming sense of terror that you're going to lose your home. You can have some confidence moving forward to fight this and fight it bravely. Speaking of, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.